Perfect. All right. Thanks everyone for joining the workshop. We hope you enjoy it. So just a quick background on Delphi. We're obviously a research firm, one of the, I guess, most well known in the space, and we also have the labs arm with which we've worked. Token economics is probably our specialty. So we've worked on designing the tokens or building the tokens of many of the sort of leading projects in the space. So we've worked with Aave on their Avenomics, worked with Compound, we've worked with Synthetix on asset listing framework. We designed the Axie Infinity AXS token. Worked with a bunch of projects like that, Balancer and many others. And so this is something that we think about a lot and an area that we really enjoy. On this workshop, we're going to try and first of all give you like a high level intro to how to think like the possibilities behind tokens, and then what we're going to do is go sort of like historically through the different token models that happened in sort of DeFi history and in crypto history, and talk you through each one and like what we like about them and what we don't, because we think that's kind of the best way to give you an idea of the design space here. I want to make it like pretty conversational. So if you have any questions, I'm going to have the chat open, so feel free to ask any questions. And and Jan, I don't know if you want to intro yourself quickly, but.
Yeah, nice to meet everyone. My name is Jan. I'm co-founder of Delphi Digital. I think Jose did a pretty good job of kind of summarizing what we do at a high level. And so, happy to kind of dive into this.
Awesome. All right. So in crypto is pretty different from traditional investment. Sorry, let me, 1 second. I'm gonna fix my headphones. Can you hear me all right?
Mm-hmm.
Damn, but why isn't it going through my headphones? 1 sec. Sorry, guys.
No worries.
This is a classic for those who've been on calls with me before. Does it work? No.
I think so.
Whatever, I'm gonna have to go through. Is my audio all right? Because it's just not going through my headphones.
Mm-hmm.
Okay. Yeah, it's perfect. Yep.
Cool. So yeah, in the traditional world, investors, there's risks that investors have to look at, and this also applies from the perspective of founders, right? So you have to think about, will your project create value and attract users? Will the project be able to be defensible and establish a moat, right? But then with token projects, there's a third question, which is, will the value captured actually accrue to the token? And this is a really important question because a lot of times projects have equity as well, right? And when a project has equity and a token, like many of the exchange tokens, like Binance, like FTX, like those kinds of tokens, you're always competing for the value that's captured, right? Revenue that Binance is using to burn tokens isn't being paid out to shareholders, and vice versa. And so it's really important when you're designing tokens, and especially because the design space for tokens is so broad. So like unlike equity and debt instruments, which are pretty well understood and have like specific characteristics, people understand them. With tokens, you can kind of design them to do whatever you want. And some of those things we found are like very bad at capturing value. So like medium of exchange tokens, that was the big 2017 thing, right? You start a project and you're like, my token is like, you have to use this token to interact with my product or service. And that we found is not a very good token model. And since then there's been kind of a lot of evolution. And we found like tokens that actually work long-term at capturing value. And so with crypto, you want to make sure that your project passes like all three tests, right? It's a good, the project creates value, it captures value, and that value flows to the token. And then in terms of token design characteristics, it's really difficult to sort of put them into a box, as you can see here, which is why we used several boxes. So there's a lot of different types of tokens that people use. The token can be a governance token, as most tokens on Terra are. That's generally one of the features, not all of them. Governance in itself is in our opinion always pretty valuable because it's an option on future cash flows, right? So like Uniswap token is a good example. It's a governance token. It doesn't capture any fees right now, but in the future, the protocol can choose to capture fees. And that's where the kind of implied value of the Uni token comes from. collateral. Synthetix, which we'll talk about in this presentation, is a good example of that. Algorithmic or elastic supply, obviously like Luna and some of the algorithmic stablecoins are good examples of that. Cash flows / yield, and supply burns, probably in the same characteristics. So cash flows, yield, you have Sushi with its X Sushi. Supply burns, you have Maker, which we'll go through. There's membership benefits like discount tokens, like Alpha's recent token, which gives you different discount tiers based on how much you stake of it. So there's a big design space of what you can do with your token. At a high level, what I would say is like there's two very important parts of the token design process. The first one is the token's utility. So what it actually does, which is what a lot of this stuff relates to. And the second one is distribution. So how you distribute it and who you distribute it to, right? And so we're going to touch on both of those here, but utility and distribution have to be thought of together because you want to give your token to the people that it will be most useful to, right? So they don't dump it as soon as they get it. So you want to make sure that the people that are getting your token are the ones that make the best use of it, and also that they're the ones that will add the most value to the protocol. And so we see that a lot with crypto projects. They're like two-sided marketplaces, right? Maybe you're doing a money market protocol or an exchange, and you need liquidity there before traders can come in. And so you want to give a lot of your distribute a lot of your tokens to liquidity providers to incentivize them to come in. Yeah. If you have any questions or anything on this high level stuff, NFTs bonded to the platform. There's probably I'll get to that at the end. Probably easier. You can have like LP tokens and bonded tokens act as a right of governance, but you have to figure out like how much governance power those are entitled to, and then make sure that there's no kind of attack vectors. Because the thing with the governance token is that's nice about it is that the especially for example in a case like Aave, let's say, where the token or Maker even, where the governance token is actually like underwriting the protocol, right? Like with Maker, if there's a shortfall event, or with Aave, the token is minted to underwrite the protocol. And so that means that the governors actually have like some skin in the game, right? Like if they make bad decisions, they actually suffer because their governance token loses value. It gets minted to pay for their bad decisions. And that's a really nice mechanic to have, which you don't have if you have like a bonded NFT, for instance, right? Like the NFT will still be valuable. And so like those governors have less skin in the game in a sense, but we can get to that more in the end. And now we're going to go through some of the projects. So starting off, I think with Maker, which was like probably the first big successful DeFi project. I don't think we need to spend too long on here, Jan, like describing how it works. Probably we can just do a brief one, and then we can go into how the token works, what we like about it and what we don't. And we'll keep going like kind of historically to give you an idea of how this stuff's evolved and what we like and what we don't like. And feel free to like Eloy, ask questions throughout.
Yeah, no, so Maker's a platform everyone's familiar with. It's kind of one of the first DeFi primitives. The idea is you deposit ETH and you can borrow against your ETH by creating DAI. And there isn't really any kind of direct credit risk because the debt that you're borrowing is always over collateralized. And so the idea is it's always roughly 1.5x collateralized. So for every $1,000 worth of ETH you deposit, you can mint $667 worth of DAI. And so the kind of the way this design works from a token perspective is, so the real, in theory, you could have a situation where if you just created this platform without the Maker token, the idea is people can still borrow and lend. So where does the token come into play and why does it make sense? So from a value accrual perspective, the token captures the stability fee. So all of the borrowing costs that are paid for by users are effectively used to buy back and burn Maker. And so that's the value accrual mechanism. And I guess, why do you need a token in the first place for something to accrue value? Well, aside from that, it kind of has two functionalities. One being on the governance side, and the reason that what they do with governance is, so the idea of the platform is to create a stable price around DAI. So where does the value of the governance come into play, and how is the kind of skin in the game aspect reinforced? So the way that governance comes into play is that these users can decide on the level of leverage that can be like the level of leverage that can be taken against different assets. So how much you can mint against different forms of collateral, along with the stability fee itself. So if the DAI peg is well above $1, then what they would do is they basically raise rates so that it becomes they would lower rates so that people are incentivized to borrow, increasing DAI supply and bring the peg below. Conversely, if the peg is below $1, they would vote to raise rates, which incentivizes less issuance and also incentivizes more repayment, which means that users would have to go out, buy DAI, pay off their debt and reduce supply. And so it's kind of like the Fed to some extent, where it is, if the price is below a peg, you want to reduce supply. If the price is above a peg, you want to expand supply. And then the way that it's kind of reinforced in terms of having skin in the game is, so in a situation where there's a massive drop in price and liquidations can't be made in time. So the idea is there's always this buffer where you start getting liquidated at 130%. So if your collateral is $130 and your debt is $100 at that point, if your collateral drops below that 130%, you start getting liquidated, which means they sell off some of your collateral to pay back the debt and ensure that the system is always sufficiently collateralized. What happens in a kind of a one-off event, which happened in March of 2020, is that if the price of the collateral falls too quickly, then something needs to happen to protect the system. And so the same way that the Maker token accrues value from burns, it also is the kind of the source of capital when there's a shortfall. And so Maker is basically minted and sold into the market to raise capital to offset the deficit. This design, when it first came out, was kind of one of the first value accretive token designs, and kind of why you started to see a lot of excitement around DeFi in terms of the value accrual mechanisms and a tangible path of adoption and value accrual, or a tangible relationship between the two. There's kind of downsides to it where users themselves aren't really making the most of the token. If you're a borrower, there aren't really additional benefits you gain from interacting with the token, which is potentially an opportunity left on the table. And then simultaneously, in those events where there's a shortfall, if you assume the market is falling rapidly, and as we all know, all prices kind of fall together. And so what you see is a situation where price of Maker token is falling and the token needs to get issued to be sold, which only further exacerbates the kind of the price decline. And basically what that means is when the token is doing poorly is when you're actually selling it, because that's when you need to raise capital to kind of fund that deficit. And simultaneously, when the market is doing well and there's healthy levels of borrowing and fees accruing, the buybacks are always happening at higher and higher levels. And so it makes sense, but it's not the most elegantly designed solution, because you're selling at the bottom and buying at the top effectively. So while the mechanism makes sense, it's not the ideal way, but it was a really key primitive in terms of trying to connect adoption and value accrual.
And just a few points there, like governance is actually really important in this system, right? As Jan pointed out, like the governors are making the risk decisions, they're making the decisions on leverage, and these decisions affect users who are like third parties of the system, right? Like if you're a user of the system, you just want to use it, you don't want to make governance decisions, but someone needs to make those decisions, right? And so the Maker token is first of all, the governance is actually coded into the protocol. So these decisions are made in an automated like governance process. It's not like people vote and then some developer goes and like builds what people said. It's actually coded into these parameter changes are coded into the protocol. And then the second one is that, like Jan pointed out, there's this skin in the game on both sides, right? Where the governors are making the upside, and they're also underwriting the system on the downside, which creates a good incentive for them to make like good risk decisions. And then the only thing I'd point out about the burn, other than that, is that token synths have kind of innovated so a burn, like mechanically, it's distributing like the profit, right, to all token holders. Anyone who holds the token benefits from the burn because the price goes up. Whereas Other projects have instead chosen to, for instance, incentivize like stakers only, right? And so you have to stake the token, you have like a 14-day unlock period or something, or even maybe a multiple month unlock period. And that way you're actually like isolating the people who are taking the risk and who are making decisions, because someone could hold Maker and vote, but then like they could sell as soon as something goes wrong, right? Whereas a staker can't do that. So that's another way in which the mechanism was innovated on. And then all I'd say in terms of governance is that some projects don't need decentralized governance, right? And it's kind of just like where to have it in. Like if you're building a wallet or a dashboard, there haven't really been like good decentralized governance models there. So I think token models there have to be slightly different. But yeah. And then I think now we're, Jan, are you good to move on to Synthetix?
Yeah.
Cool. So Synthetix is a really interesting one. It was one of our early reports in like back in like August 2020 or 2019, whenever it was.
2019, yeah.
2019, yeah, that's it. August 2019. And it was a really interesting one because the token utility was interesting, and also the token distribution was really interesting. I don't know, Jan, you want to go over this one as well?
Yeah, absolutely. So the idea with Synthetix was create a synthetic platform where using a pool of underlying collateral, derivatives would be minted against this underlying pool, and as long as there's a sufficient amount of capital in this pool, you can kind of issue any type of synthetic asset as long as you had a price feed. And so the idea was you'd be able to have the ability to invest into any kind of synthetic with zero slippage, because you're not really buying off of an AMM or an order book. You're basically changing the underlying exposure of this of part of this collateral using a price feed. And I think Synthetix was certainly an innovator in terms of in a lot of ways. And so one of the things being just the overall token design, where they were the first to really build out liquidity mining. And so this happened in a few ways. So I guess we don't necessarily need to go through every exact element, but more so the token economic side. So they launched early and with at a very, very low price, and what that enabled. And they also, I think, were the first ones to really have a monster community. And part of that was, it was an early DeFi primitive that was really well designed. So you had a lot of kind of early DeFi investors flock to it and really develop an interest in it. It allowed for a pretty wide early distribution of tokens, where a lot of people were made pretty good returns off of it, and now had a very strong vested interest in seeing this develop and do well, just based on where their bags were. And so the combination of all that, basically the way that it worked was users would take SNX token, deposit that was the form of collateral against what a lot of the what the synths would be issued against. And in order to incentivize users to do that, they would pay you with inflation that came with a lockup. So you kind of created this sticky pool of collateral that can be issued against, created an incentive to do so, but also that lockup reduce the short-term volatility of users moving in and out of the yield farm. And so
I think it also really helped with the community, right? Like the fact that these rewards were locked up meant that all these community members they couldn't just like farm and dump, right? They had to actually stay interested in the project because their rewards kind of depended on that. And so I do think that also helped like foster that community interest. And it's something that we try and do when we're designing like yield farming campaigns, is find ways to actually either punish sellers or reward like holders and participants. And there's a lot of ways to do that we can help you with during the hackathon.
Absolutely. And so, in order for this protocol to work, there needed to be some underlying pool. And so it made a lot of sense to kind of align all the incentives here, where the goal is, if you have everyone act in their own best interest, you need to ensure that when they do that, it is to the benefit of the protocol. And so like, it's almost like just the basic underlying assumption you should be operating with is that people will always be acting in their own best interest. And so how do you kind of guide their actions to actually be value accretive? And so in this case, being early, providing a lot of capital, and leaving in there for as long as possible was the best thing for these users to do. And at the same time, in order for the protocol to develop, there needs to be a large underlying pool of collateral that was stable, in the sense that not a lot of it was being pulled out and was steadily growing, which was happening as people found out about the project and kind of took advantage to gain the yield. And so in order, once the kind of the pool of underlying collateral hit escape velocity, in the sense that there was enough capacity there to facilitate a decent level of trading, the idea would be that the protocol would kind of gradually switch from rewarding users purely with inflation to bootstrapping enough underlying capacity so that the trading volume could actually become a meaningful portion of the fees that users received, and in turn allowing the mechanism to become much more sustainable, and basically shifting from an inflation-driven one to a fees-driven one. And I think this is kind of the underlying assumption for a lot of elements of crypto, even Bitcoin. The whole idea is you continue rewarding miners block rewards, and as the asset gains adoption and utility, the fees will gradually come in to replace those rewards. And so it's a similar idea that's kind of applied in different ways. And I think this was really one of the most kind of unique designs in terms of SNX. So we don't necessarily need to go in like how Synthetix works. I think the more important thing is really addressing the motivations behind different elements of the token as well.
Yeah, exactly. It created like this really positive reflexive loop, right? Where this thing, it needed enough collateral on it to be able to mint the Synthetix for people to trade, and the rewards really helped with that. And then more people can come into trade, which creates the fees and creates that nice like reflexive loop. I think the next one might be Thorchain. Let me see. Yeah. I mean, this is like, we don't have to go into this, but every token model has its drawbacks, right? So like SNX is the primary form of collateral, is very limiting to the size of the synth market when you compare with something like Mirror, right? Which has come along afterwards on Terra, and allowed people to mint Synthetix with UST, and now expanding to like Luna and other assets. That makes it much easier to bootstrap the market. And then also the pooled collateral.
Like they have expanded again a lot, like away from that, just but again, it was a growing pain and something that initially they were able to kind of work out of. But yeah, I agree. Sorry, just wanted to kind of clarify that. Yeah.
And then the pooled collateral model is the same, right? Where like a pooled collateral model makes it so that token holders are counterparties to all trades. So it's difficult for like as a token holder for you to know what your actual exposure is, because you're always trading against like everyone else effectively. And that's different compared to something like Mirror, where each synthetic asset is minted sort of like on an individual basis, and like those models each have their trade-offs, right? So
with Mirror, the trade-off that basically is that with this centralized pool of collateral, the idea is you're not really trading one asset for another. You're effectively just redeeming one. If there's $1 billion in terms of like the overall minted synths, and you own 100 million of BTC, you can just exchange that for 100 million of ETH, and there isn't really any slippage because you're just shifting the underlying exposure of that.
It's just accounting, right?
With Mirror, right, exactly. And whereas with Mirror, because you don't have this commingled pool and everyone is able to kind of create their own exposures, you do need a more traditional form of execution, in the sense that you're either going to need an order book, or as Mirror does with an AMM, to trade from one M asset to the other. So what you kind of offset in potential minter UX, you kind of negate through the kind of transaction element of it. And so we're still really watching both closely to kind of understand which model works better, but it is really interesting to see these two different types of designs.
Yep. Uniswap. I think Uniswap is mainly interesting to go through what happened with SushiSwap, because we don't have time to go through everything, and I want to end in like 10-15 minutes so that there's like at least 10-15 minutes for questions. So we're going to assume that most people know kind of how Uniswap works, and then I think that the SushiSwap is a really interesting example of how a token can be used to really like do what was called a vampire attack, right? Where you're pulling liquidity from another protocol using your token as incentives. So Uniswap didn't have a token for the first 2 years after it launched. A lot of people think that they launched their token as a response to SushiSwap. And so in August 2020, anonymous developers forked Uniswap and created what was called SushiSwap. They attempted a fair launch where there were no VCs or investors, which again was sort of like as a foil to the narrative behind Uniswap, where obviously they were backed by Paradigm and and stuff like that. And then while Uniswap didn't have a token, Sushi used its token to incentivize liquidity providers to move over by juicing their yield. So in addition to the yield that people were earning on the actual pools as fees, they could earn this additional yield in Sushi. And so they managed to pull like a lot of liquidity from Uniswap, as we can see here. And there are lots of examples of ways we can do this. I think we're just kind of scratching the surface of what's possible here. I think there are possibilities for like cross-chain vampire attacks, where you're specifically incentivizing users of other protocols, potentially of like similar protocols on other chains to move over with targeted airdrops and stuff. There are things like, you know, whitelisting specific wallets to be able to farm or to be able to earn certain airdrops. So I think there's a lot of ways that this can be done, but like SushiSwap was a really cool example of the impact a vampire attack can have, right? Pulling like $1 billion worth of liquidity, over $1 billion worth of liquidity from Uni. So this is an example of great token distribution, right? Like using your token to really bootstrap that supply side. Yeah, and then Uni launched their token. Like there's a lot of questions. So the Uni token, so like since then, Sushi has a 5 bips sort of fee that goes to Sushi holders, to ex Sushi holders, whereas Uni still has no value accrual to Uniswap token holders. So that's pretty interesting, where like Uniswap's obviously incredibly valuable, the token, but it's earning absolutely no fees right now. And it's arguably not really even a governance token, because there's not that much governance sort of happening through it. But I think the idea is for that to happen over time. And so again, like some different design choices there in terms of what's being done. And so obviously with something like Uniswap, with SushiSwap's design, you incentivize more community participation because you actually have a governance process, and also because people are earning fees for staking and participating in governance. Whereas with something like Uni, it's very much like the community governance process really isn't developed yet. Anything you want to add there, Jan?
No. I think that was a great summary.
Cool. And then so Thorchain. So disclaimer: we're investors in Thorchain. It was our first investment actually as a venture fund, and we're big fans of the project and wrote sort of a report on it in December 2019 as well. So this was really interesting because it built on both like Synthetix, especially on Synthetix, and kind of innovated and did a few like really cool things on top. So I'll let Jan cover this because him and Macedo on our side were unearthed this for us. So go ahead, Jan.
Thanks. Yeah, no. So I think Rune was a really interesting project in a handful of ways. So it was this was as when application-specific blockchains started gaining prominence, and so those introduced new features, but also kind of created new challenges. So the first thing is that you have considerably improved scalability as you kind of step away from Ethereum, particularly back before we even had any kind of real layer 2 solutions. And so that's the simple benefit. The trade-off is that you now have to figure out security. So with Ethereum, with Maker, with Synthetix, the reason that the transaction fees are high is because it's all built on Ethereum and you're borrowing Ethereum security. And so the idea is the protocol you're building is as secure as the kind of the network itself, and that's no longer something you really need to include in your calculus. Here, so with these Tendermint-based chains where you have certain
like Terra,
nodes, and the idea is like Terra, exactly. So you have a certain amount of nodes, and if you depending on how many of them you control, you can do different levels of malicious activity you can basically stall it at a third and really do something, you know, much more malicious when you control 2/3 of the nodes. So what does this introduce from the token econ side? Well, you know, if you're thinking about Bitcoin and ETH, a lot of what all the inflation is going to is security. And so now you have to think about a security budget. And
any project built, sorry, obviously any project built on Ethereum, for instance, doesn't have to worry about security, right? Like users are paying for that when they pay the absurdly high gas costs, whereas a project like Rune does have to think about its own security as part of the model. But yeah, go ahead, Jan.
No, yeah, you're absolutely right. And so, you know, with a project in Ethereum, they dedicate their issuance towards value accrual for the token or incentivizing users to behave in a certain way. Whereas here, now you have to think about security as well. And so what we really liked about this design was that they made security scale with adoption. And so by creating that kind of relationship, you really need to incentivize adoption and you allow security to scale with it. And so how does that really happen? Well, the idea is, so Thorchain basically has, so it does cross-chain liquidity. So the idea is each pool is a certain asset and Rune. So
it's like a cross-chain Uniswap.
Right, and so you assume every asset, rather than, you know, how most things on ETH on Uniswap are certain asset ETH. Here, every liquidity pool is an external asset and Rune. So all the liquidity in the pools, half of it will always be Rune, half of it will always be external assets. At the same time, you have the nodes that validate and run the network, and those are all ran by staking Rune. So in order to become a validator, you have to stake a certain amount of Rune, and so that's kind of where the security element comes into play. So how does the security scale with price? So the idea is inflationary rewards are used to incentivize liquidity into these pools. And so as you know, as we described that relationship, every time an external asset is added, Rune is also added. So both, so you have the kind of the 50-50 that sits in the stake capital. And then the way that they're incentivizing security is that they have this thing called the incentive pendulum. But the idea is it's designed in such a way to incentivize bonded capital to always be 2 times or to always be effectively the same size as overall LP capital. And since LP capital is 1 part Rune, 1 part external asset, bonded capital is going to be 2 parts Rune. So the kind of the deterministic price is that the value of Rune in the network should always be at least 3 times the size of the amount of outside capital in the network. And so this is at 2 parts, 1 part, 1 part. And so what that means is, as users deposit more capital because they're incentivized to do so, security will also scale with it, because at the same time you have, you know, the price appreciation of Rune, and you have nodes that come in and kind of operate. And so whenever this is out of balance, what happens is they shift rewards to and from bonded and state capital. And in terms of like, there's always going to be rewards going to both, but the share that goes to, so if there's not enough bonded capital, they increase the share of the rewards that go to those users, so that more nodes come online because there's more rewards for them. And same thing with state capital. If there's way too much bonded capital, not enough state capital, that basically means you're overpaying for security to some extent, and you want to incentivize more liquidity to come into that state capital side. And so this works to function as both a really great way for the Rune token to accrue value as more capital is added to the platform, and for security to kind of scale with the amount of capital at risk, because, you know, the kind of the prize or what's at risk is someone coming in and stealing that state capital. So if you ensure that you need to control 2/3 of the bonded capital to steal the state capital, first of all, it's very difficult because nodes churn in and out. So the oldest one goes out while the largest one comes in. So it is very difficult in that sense to actually get to that level of control of the platform. But it also ensures that there really isn't a viable economic attack vector. So you obviously, you have to, there's no like economic attack that a rational actor would use. And even an irrational one, it's very, very difficult to actually own that many nodes in the bonded capital portion at the same time in order to kind of pull off this attack.
Yeah, and so obviously, Jan explained it really well. But if you have if you're bonding as the maximum the nodes can ever steal is sort of a third of the value they have bonded, right, in external capital, and so it makes it a very like a suicide attack, especially considering that and you know, a node attack would kind of destroy the value of Rune as well, and so you'd be destroying the value both of your stake, and you'd only be able to steal an external value like a third of your stake anyway. And so it makes it very like it makes it very hard to attack. And yeah, like what Jan said there is exactly right about security scaling with adoption. It's like on Ethereum, an application might launch and they're at a very early stage and they're still paying the same gas as they're still paying the same amount of gas as any other application, right? No matter, it doesn't matter if it's a CryptoKitty or a massive like borrow transaction on Aave, it's the same amount of gas. Whereas with Rune, like the sort of cost of security and the amount of security actually scales with the adoption of the network, which is really nice. And it also means that Rune plays an essential role in the system, right? It's not like a governance token that sits outside of the system and captures some rent. It's actually like a key part of the system, not just for bonding, but also as like the cross-chain bridge asset, right? That's one half of every pool. And then do you want to talk about distribution as well, Jan? Like what Rune did here with the distribution, kind of learning from Synthetix and how that worked?
Yeah, so the distribution was basically, they allowed, in the beginning they had Rune Vault, which was just a way to kind of distribute tokens to as many users as possible.
This is outdated, by the way. Rune price is about 20 times higher now.
Right.
But yeah.
And then and kind of the longer term plan was that individuals who were running nodes and providing liquidity would also kind of receive those rewards, and the goal there was to reduce concentration. And basically, I think over time it gets more and more difficult to kind of take control of the network as there are more nodes in the network, meaning that you just have to control that much more capital to actually take control of them. So in the early days, they tried to go with as widespread distribution as possible, just to kind of mitigate that attack vector in the early days. And so now it's gotten to the point where it is decently widely distributed enough where it just becomes considerably more difficult to get enough nodes or get the Rune needed to get the nodes to then try and attack the network.
Yep. Yeah, that's it. We were going to cover some more stuff, but I think this is probably enough for this session. We have like we could talk about this stuff all day, but probably we'll open it up to questions from the community. I know there's some already from George. We can start with that, and then if any of you have any more questions, feel free to write them in the chat, and we'll get to them. So George asks, how do these projects really raise funds through these mechanisms? I assume they keep a percentage of the minted tokens in a development fund wallet, and they periodically sell it for ETH. So there's different ways to do that, right? So in terms of raising funds, you probably need some sort of, I mean, obviously like private sales and stuff like that, and also where like if you're a hackathon project, I think both Delphi and IDEO would be very interested in funding you. But in terms of like decentralized mechanisms, there's auctions like LBP style mechanisms, initial bonding curve offerings, all that's coming to Terra soon. And then in terms of the distribution, like with Rune, for example, that's what happened, right? They had like the Rune token, and they were very transparent about how they were using it, and they were selling that over time in order to fund like development costs. And you know, they had like a very transparent report to the community every week with how much they had in stable coins and how much they had in Rune and stuff like that. And generally, these distribution events, or like these yield mining, yield farming, whatever you want to call it, liquidity mining, yield farming, whatever you want to call it, are very good for the token value, because they really bootstrap the fundamentals of the platform. And so they open up that possibility for the project to sort of sell tokens to fund itself, and they also make the treasury extremely valuable, right? Yeah, Jan, anything you want to add there?
Yeah, and so obviously, if you're the team, you only want to sell a certain amount of your tokens early on, because you know you're effectively selling at what is likely a very cheap price relative to what the token can achieve. So you'll see these projects do like you know, when they're doing any kind of private fundraising, there's a certain amount allocated at different stages, and then even once they do the public launch, they're only selling a subset of tokens, and over time like the treasury itself. So they'll have, the funds for the team, and those aren't really able to be used. And then you have the treasury itself will hold some tokens. So what will often happen is they can sell to individuals with lockups so that they can gradually de-risk their treasury so that it's not purely in their own token. And that way, in a bear market, they do have the capital needed to kind of continue funding operations. And so that's one of the more useful mechanisms that a lot of the funds we use. It's like a gradual dissemination of supply rather than really selling it all at once and not really being able to maximize on the growth of your project.
Great, yeah. And then Vol had a question about what are some great approaches you see used to keep LP providers in yield apps for longer? That's a really good question. So there's a few interesting ones. So like one that we've been playing with and that kind of inspired by Curve is the idea of offering like yield. So let's say with an LP pool, you offer a certain yield to a pool, but then you allow users to lock up their LP tokens in that pool in order to gain like a higher percentage of that yield. So effectively they're getting a multiplier on the yield that they're earning if they're locking up for longer. And then the reverse can also be done where you have some like rewards, and if you withdraw early, you get taxed on those rewards and they get redistributed to those who stay in versus people who, so it's like the reverse there can be done as well. And then in general, I think another important side is I assume this is to do with the governance token. It's having a good reason for the people earning the token to also like stake it. And so what we really like here is the Curve model has been one that we're really like inspired by, in that it's a model that really incentivizes LPs to become token holders and token holders to become LPs, right? So stakers in Curve, so they can stake their Curve for differing amounts of time, and they get this VCRV, which represents their voting power in the system, right? And the longer they lock for, the more VCRV they get. And with that VCRV, they can actually direct what pools issuance goes to. So if you're a big LP and you're providing liquidity to a pool, you want to make sure that your pool is the one getting the most rewards, and so you're incentivized to become a staker so that you can vote on where rewards are going. And in addition, stakers also get a pro rata share of half the fees that Curve collects. So half goes to liquidity providers and half goes to stakers with based on how long they lock up for. So if you're a big LP and you want to maximize your earnings, you're effectively like getting your fees back if you become a staker, and then you're also being able to increase your earnings by like directing issuance to your pool. So we really like token models like that, where, and there's a trade-off, right? Because with a token model like that, you don't really incentivize like investors to buy in. Like, we love Curve, we'd love to own it, but it's not really like, unless we're big stablecoin whales, it's not really a token that we can own because you're constantly being diluted. But and people criticize that, but as a protocol, that's a good thing, because you're effectively diluting passive token holders in favor of active token holders, right? And so you're making sure that kind of every token you have is owned by someone that's also like a liquidity provider. And then that has like the added benefit of, if a competitor is launching and they're trying to pull liquidity from you, not only do they have to pull liquidity, like also all your liquidity providers are like big token holders and probably locked up for a while, right? So they're not really incentivized to switch. They're like very invested in the success of your platform. So it like doubles up as a really nice moat on the supply side. Yeah, I don't know if you want to add anything there, Jan.
Yeah, and even in some situations, you can add elements that are pretty trivial but somewhat useful, where a certain portion of the rewards that a user is entitled to can be burned based on how quickly they withdraw liquidity, and then potentially recycled to those who stay for longer as a way to kind of incentivize a bit more stickiness and reduce the kind of the impact of mercenary yield farming.
Cool. Are SAFT still used for private sales? Yep. Yeah, for sure. What's the current investor lockup vesting market practice? Generally, investors should be locked up for like less than the team. It varies from sort of like 6 months to 2 years, probably, for investors. Some projects try and lock up investors for like 4 to 5 years, and you can pull that off if you have a lot of market power and stuff. But we're not really huge fans of this like very low float, huge, fully diluted valuation style sales that are happening now, because it just creates a scenario where you launch your token and it has a huge valuation, which is like very hard to sustain. And as more supply hits the market, the valuation kind of goes down, which just creates negative feeling in the community, because anyone who buys the token on the open market after launch is just kind of getting like diluted and losing value over time. Whereas like insiders are the ones who benefit from it, but it also kills like community momentum. So I think vesting is a good thing, but you got to be careful that you don't end up with like a tiny float, right? That just means that the token price is like the fully diluted is going to be huge, and you're going to end up getting a lot of people wrecked. And yeah, teams should be locked up for at least sort of 3 years. You know, longer is better. Any advice on deciding? Oh yeah, Jan, you want to add anything there?
On deciding
On the vesting?
price. Oh, I saw any advice on deciding price. Oh, current investor lockup. Yeah. Team always longest, and then usually advisors either somewhere between team and investors, but you know, you can be a bit more flexible there, and you don't necessarily need like a egregiously long lockup, but I'd say for the team, what usually happens is like a 1 year cliff or something along those lines, and then a 2 to 3 year vest. And then I think investors are comfortable getting some early liquidity, so there doesn't need to be like a really long cliff, but and then have the vest over a couple of years. And then a similar idea with the advisor side, like you don't necessarily want these large liquidity cliffs where there's a lot coming unlocked at once, and you know that's usually pretty well dealt with. If you'll have investors who will sell locked up tokens to future investors at a discount, and kind of that just helps spread across the simultaneous unlocks. But in terms of like by having a slightly earlier cliff and then a longer vest, I think it smooths out the distribution and also helps avoid the situation where there's just not a lot of circulating supply for a while, and then kind of having it all come at once and get like manufacturers unnecessary volatility.
Yeah, you also want to make sure those big unlocks are coming when there's like real utility for the protocol and it's up and running kind of thing, so that there's, you know, more sort of buying pressure that can come in to compensate that. Any advice on deciding on a price for tokens when launching, Jan?
Is that on an individual price basis, or I guess the market cap itself?
Yeah, because you don't really decide on a price. It's an annoying thing about sort of markets that tend to do that. You have to kind of figure out. Yeah, you do have to sort of figure out what the price is going to be to do the token distribution. So you figure out how much you're sort of giving away, how much you're distributing. But you can also change that with governance. Yeah, go ahead, Jan.
Yeah, no, just gonna basically just like kind of echoing what you're saying here, and it's simple, or it's naive, but it still does help where a larger supply and smaller token price is like almost better received, even though this is kind of like the silly things that carry over from 2017, where you know people were yelling that Ripple's cheap because or XRP is cheap because of the token price. But there is some benefit to having a larger supply in terms of quantity and a bit smaller price, even if it's just, you know, purely psychological. But yeah, the market cap ends up being kind of a function of the product and the space you're competing in, and the investor appetite, and you know, all of those kind of elements.
Yep. How likely is the risk of governance tokens deemed as securities due to protocol fees flowing to stake token holders? We're not lawyers, so please don't interpret this as legal advice. We have spent a lot of time speaking to lawyers on the various kind of tokens we designed. There's a few mitigants here. So a big one is if the staker is providing some other service in addition to governance. And so because that breaks sort of one of the prongs of the Howey test, right? Like the Howey test is when someone invests in something with an expectation of profit that comes from the effort of others. And So the effort of others thing is the one that well-designed tokens can kind of, I won't say skirt, but just don't qualify for it, right? So for instance, with Synthetix, you're not just staking and earning a yield, you're actually like the counterparty to all the trades on the platform, right? With something like Aave, when you're staking Aave, you're actually underwriting protocol risk. With something like Rune, when you're staking Rune, you're validating like protocol security, providing a service to the protocol. So ideally, governance should have sort of something else to it, some service that's being provided to the platform. That doesn't always happen. So like Sushi, for instance, the governors aren't. I mean, they're governing, right? They're just voting on stuff, but it's not mission critical. Same thing with Uniswap. Sometimes it can't happen. In that case, what you want to make sure is that it's sufficiently decentralized, right? So that there's sort of enough meaningful decentralization. And again, there's like lawyers in different jurisdictions that will argue for different ways of doing this. But the idea is that yeah, the decisions should be, there should be like a situation where if the core team is to disappear, the protocol wouldn't just die, as like a test of whether this is decentralized enough. And that's just because then it means that there's like no entity that's issuing these securities, right? It's like a decentralized project. But again, this is all my not a lawyer caveat opinion. Jan, you want to add anything there?
No, I think you summarized pretty well.
Cool. Locking. Oh, should we reserve tokens for LPs even if we don't set up pools ourselves?
Is that as in like, should you be providing liquidity?
Yeah, I don't quite get this one. Maybe George can clarify a bit. Locking the tokens for longer or staking has only the advantage of reducing selling pressure, right? Or something more.
So that's the kind of the idea behind the curve, where by staking for longer, you can actually, the goal there is to align LPs as an incentive and token holders, where typically you don't really have that alignment, in the sense that, you know, LPs will come in, they'll farm a token, and they can either stake it to earn more yield or kind of sell it. Whereas by aligning LPs in the long run with token holders, it ends up being value creative. And the way that's basically done is you can, when you stake, you get like a voting power, and that voting power is a function of how much you stake and how long you stake for. And so with that voting power, you're able to dictate some of the inflationary rewards to certain pools. And so by being able to do that, if you're a large LP, you now have an incentive to be a large token holder, because you can direct more rewards to yourself. And so it ends up creating a new utility for the token, outside of just being kind of a claim on fees and a source of rewards to users.
Yeah, there's definitely a lot more benefits than just reducing selling pressure. Like aligning incentives has huge benefits. It has huge benefits on community, where if someone's locked up for a while, it means they basically are going to care about your project for at least that long, you know. And depending on the amount they're locked up, they might care a lot, right? And with something like Curve, it's a good example where if a lot of the LPs are also token holders that are locked up for a long time, it's going to be difficult for anyone to come and unseat them, right? With Uniswap v3 launching their Curve pools, it's going to be difficult to pull liquidity there. And so there are those kinds of advantages. There are also advantages in terms of caring about governance, just generally sort of being interested in the project. And then it's just a nice mechanism where you can sort of allow people to be rewarded for their commitment and like belief in the project, right? They can effectively trade like short-term liquidity for larger long-term upside. And so you're kind of redistributing tokens from short-term oriented people to longer-term oriented people, which is also a very nice mechanism to have, where you end up with the stakeholders who own most tokens are the ones who believe in the project the most.
Yeah, so and I do think it makes sense to reserve some tokens for liquidity providers. I think it really does depend on the model and how valuable having that secondary market liquidity is, and that's a kind of a way to gauge how much you should designate to those token holders. In some cases, it's really, you know, crucial to the design of the project. In others, it's not necessarily as important. And so, it really depends on how necessary that secondary market liquidity is. If you're not sure, I think an easy way to kind of get around that is you basically reward LP liquidity providers out of a community pot, and then have some level of governance dictate the distribution schedule there. And realistically, I think it's impossible to nail down how much they should be receiving in terms of incentives. And so by avoiding finalizing that early on, you kind of give yourself flexibility to adapt based on what's happening. If your token happens to go get listed on a large exchange, then maybe it's not as necessary. But if it's if the LP element is very crucial to kind of the overall decentralization and the need for liquidity, if there's some kind of liquidation mechanism built into the protocol, and so it needs the liquidity on a DEX in order to function properly, then sometimes it makes more sense. It makes sense to kind of dedicate more rewards to the liquidity providers. So I'd say it is really conditional on the design, but one way to not pigeonhole yourself is to put it into as a share of the community bucket and shift that with governance. You can also just have, like, even if you set that 10% aside, you can vote on how quickly you want to distribute it, and that's effectively the same thing in terms of increasing or decreasing those rewards, and potentially in the end just kind of use governance to roll that back into the community fund, since in the end it's all part of the same bucket. It's just like how it's really being directed.
Edgar, how are we doing? Can we answer these last two, or is there another workshop happening now? We should end.
We're good. So
okay,
we can answer the questions.
Cool. So thought process when choosing between a capped and uncapped supply. Probably I'll let Jan give his thoughts here as well. But for me, I think capped supply is kind of like a meme. Like for a store of value, capped supply makes sense but like most of the stuff that you're building and most of the projects in DeFi and in crypto are not trying to be a store of value. They're like more like startups or fintech projects, building financial infrastructure, building web infrastructure. And so the cap supply thing just doesn't really make sense. Like no companies don't have cap supply, right? It's just kind of an investment decision of whether you think minting those extra tokens and allocating them to whatever you're allocating them to is going to create more value than the dilution that it generates, right? And then it's also like inflation. So for instance, a model like Curve, you do have permanent like inflation, but it's more so like a redistribution, right? And that's what issuance, like uncapped supply can do, is it can create this constant like redistribution from passive holders to active holders. So and that's really valuable for especially I think for exchanges. That's where we find it most valuable, where you really need like you really want to incentivize your liquidity providers, and there's not really much of a benefit to you of just having an investor like hold your token. It makes sense that you're constantly effectively taxing holding or passive holding and sort of subsidizing active holding, right? Holders who also provide liquidity. And I think there's a lot of situations in which that makes sense, especially for these growing networks where you want to make sure that every token is being allocated to someone who's going to also bring value to the network. So yeah, Jan, you want to add anything there?
No, I largely agree. Yeah, it's more mimetic than anything, and is really useful for the store value argument. Even though you can argue that it maybe not as much anymore, but that's where the argument exists. But I think uncapped definitely has a place in a lot of these dApps. Like, just echoing a lot of what Jose said.
Cool. And then the last one, what if I have let me see, Guy Phipps. I don't know if maybe paste it again. Oh, the complex token economics. Yeah, I'll answer George's and then that one, and then probably end there. So yeah. So what if I have end users, retail app for DeFi, for example, the users have no interest or knowledge to vote or even stake? How do I incentivize them? So that's a really good question. A lot of these like a lot of apps have that problem, right? And I think this is especially the case for like wallets and like dashboards and like user facing sort of front ends. I think there's like a few token models we've experimented with there. And again, you just have to think what is it that you want to incentivize? So I think one token model that could make sense is a discount token, right? Where users have to pay for services, whether it's a fee on actions on the app, like Zapper, right? Where there's a fee on Zaps, or it's a subscription or something like that. And you basically allow users to get a discount on that subscription by staking some amount of tokens. So like functionally, this is pretty similar to a royalty, right? Because you're just taking off your top line and giving it back to users, but it's a royalty that's only paid out to active users, right? So it's not like a dividend, whatever. Like you only qualify for this dividend if you paid fees. So that's like one example of a token model that makes sense. And then you can kind of start bundling in other features with that, like private chats, like the ability to test features early and just make it like a super, super user type thing. It's still like, we haven't seen a really successful discount token at scale. Like I guess exchange tokens are the closest thing, but they're not really discount tokens because they also have like burns and stuff. I think another thing that we've played around with is the idea of like curation. So the idea that like a DeFi front end or a dashboard is kind of like a front page for DeFi and like the one-stop shop where users go. And so if you let anyone sort of build apps for that space, or like build or reserve like real estate on that space, and then you allow users to sort of curate what they want to see. And there's various mechanisms you can do for that, but the idea is that kind of if you have these different dApps and they all have different value capture mechanisms, you allow users to stake into these different sort of, and this is very high level idea, probably easy to explain with an example, but it's basically you allow users to stake into specific parts of the dashboard and earn a percentage of fees there, and their stake also like has an effect on the algorithm of where that's shown. And so you start to involve users in curation and you reward them for successful curation. So if they end up basically voting for something that does really well, that generates a lot of fees, they get rewarded for that. And the token kind of becomes a way that you that you have like that user feedback, and also it kind of like decentralizes the whole app, right? The whole dApp into these subsections that each user can own and stake into. But that's like, again, not been done at scale, but it's an idea that we've been playing around with for a while, like a token curated registry type thing. Oh yeah, and then yeah, you want to add anything there, Jan, on the wallet token models? They're tough.
No, that'd be all. There's just no construction happening right now, so I'm gonna do. But no, I agree with what you mentioned. Sorry.
Cool. A lot of the successful DeFi protocols on ETH have relatively complex tokenomics, like CRV, especially when compared to the more simple tokenomics of projects on Terra currently. Would you be concerned about making the tokenomics too complex for Terra users? Yeah, I think Curves is, to be honest, complex by virtue of bad UX as well. Like we're obviously huge fans of Curve and like love the project, and they're super smart. But I think that project, that the tokenomics aren't actually as complicated as that. It's just like UX wise, they haven't really made an effort to simplify them, which is fine because it's not really for the everyday person. It's kind of for power users. I think like, yeah, tokenomics should be, 100%. It's an IQ test. I think tokenomics should be like as simple as they can be to achieve the goal, right? I agree that the kind of tokenomics on current Terra projects are pretty simple. I think most ETH projects have pretty simple tokenomics too, and I think Terra has kind of benefited from all the like experimentation that happened on ETH, where they've just picked like the ones that work best and the distribution mechanisms that work best. And I think we can keep doing that. I do think there's going to be and we're working on something like a curve type model on Terra, but I think it'll be simpler and sort of by virtue of the UX and stuff.
Yeah, it's kind of just like conveying what's actually happening. I think that's where it gets difficult with Curve, where you actually have to do quite a bit of DD to really understand the intricacies and what like the knock-on effects of everything that's happening. Whereas I think breaking that down a bit more and I guess simplifying the amount of decisions, but directionally still applying a similar model is the best way to kind of get the maximize both elements in terms of simplicity and like useful complexity.
And then, yeah, there's just to add to that, there's like other mechanisms like the graph, which are really interesting token models on Ethereum. Like It's very much in the spirit of the curation thing I said before. So you have like anyone can create a subgraph, and these curators or indexers can like stake tokens to a specific subgraph, and like each subgraph has like a bonding curve with its own index tokens, and all the fees get deposited back into the bonding curve. So there's a way that you can like invest, be a curator and like invest in the upcoming subgraphs. I think that's a really good example where as a user querying subgraphs, you don't actually see that, right? You don't see the token economics. You just see that the best graph is at the top, and you're getting the data that you want. And I think that's like, yeah, that's what good token economics should be like. Maybe the mechanism is complex, but the only people exposed to it are the ones who need to be. And then for the users, it's just like a seamless experience that's made possible by the token econ. Yeah, I think that's it on our side. Yeah, really appreciate everyone attending. Hope you enjoyed it, and we'll be available on chat. Edgar I mean, we'll be available on chat all day this week, and hopefully we can talk to a lot of you and answer questions directly. We've been super impressed with the quality of applications here and like the quality of discourse. So, and yeah, we just want to help you succeed. So don't hesitate to reach out.
All right.
Thank you very much,
guys.
Yeah, I really appreciate it.
Thanks very much.
Yeah.
Speak soon.
Yep. All right. Ciao, everyone.